Hi there, welcome to Chapter 12 of Business and Finance. Chapter 12 is going to be looking at corporate governance, in particular the UK Corporate Governance Code. So we'll have a brief introduction to what the UK Corporate Governance Code is, and then we'll go through the five main sections that the code suggests are important for good corporate governance, so the things that a business needs to focus on. We'll finish the chapter then by having a look at the stewardship code, and then a look at external and internal audit and the roles that those two groups can play in ensuring good corporate governance for shareholders. Hopefully you've watched chapter 11 already, which gives us a bit of an introduction to corporate governance overall, and as I said, chapter 12 looks in more detail at the UK guidance on this, the UK Corporate Governance Code. Okay, 1.1, 1.2 and 1.3 then just give us a bit of an introduction. So overall, we know that the UK Corporate Governance Code is a code of practice. So it's a list of best practices that listed companies in the UK are affected by. Okay. Now, it's not a list of rules. It's not a legal requirement for companies to adhere to the UK Corporate Governance Code. However, FTSE 350 companies have to include with their annual reports a statement of compliance or an explanation of non-compliance. Now, what that means is businesses do not have to comply with every single piece of the UK Corporate Governance Code. However, what they must do, remember this is listed companies, they have to either comply or they have to explain why they haven't. So we call it a comply or explain system. Oops. Not comply or system, comply or explain. So they either have to list and detail in the statement of compliance how they've complied with the UK Corporate Governance Code, or they have to have an explanation of non-compliance justifying why they have not. Now, you'll see FTSE 350 and listed companies used in these three paragraphs. All listed companies are affected by the UK Corporate Governance Code. Some of the smaller companies, so not the FTSE 350, they can be a little bit more flexible. So we tend to focus on the FTSE 350. Okay, so the UK Corporate Governance Code then, down in section 2, identified five main areas that affect or a business should consider when thinking about how it's directed and controlled. So remember, in the back of our minds, we're still thinking about the way in which a business is directed and controlled. Okay, so these are the things we need to consider. Remember, that's focusing on the board of directors. Okay, so the five areas: leadership, effectiveness, accountability, remuneration, and relations with shareholders. We're going to go through those sections one by one. Okay, so the first section, leadership. So we're going to make sure that the head of the business, the board of directors, is effective in terms of its leadership, and also that it has good leadership itself. So we'll run through these. There's an example for each, and they're relatively straightforward. So first up, every company should be headed by an effective board, collectively responsible for long-term success of the company. We've already spoken about the fact that there has to be a focus on long-term, as opposed to a focus on short-term profits, and that's because we're really aiming for that shareholder wealth. So we've got an example there: the board should meet sufficiently regularly. So making sure that we have regular board meetings and that key things are discussed with a regularity that means we can pick up on problems and correct mistakes as and when they occur. Okay, next, there should be a clear division of responsibilities so that nobody has an unfair balance of power or authority. So the key rule there is we say the chairman and the chief executive should be different people. So the person in charge of the company or the business the chief executive, and the person in charge of the board, the chairman, shouldn't be the same person. This just gives us a balance of power. You don't want one person having too much power because they can push through decisions that might not be in the best interest of shareholders. In line with that, then, we say that there should be at least 50% non-executive directors. So this is making sure that there's a balance so that no small group of individuals can dominate decision making. By non-executive, we're talking about independent directors who are not employees. They're not involved in the day-to-day running of the business. And they should be able to attend board meetings and provide some sort of objective and dispassionate criticism. So making sure that we've removed all of the threats of issues around profit-related bonuses, things like that. These independent directors should be paid based upon the time that they dedicate to the business. And therefore they're far enough removed to enable some sort of critique of decisions to be made. Okay, second key area, effectiveness. So we've thought about the leadership of the board, now we're going to make sure that they're effective. So firstly, there should be an appropriate balance of skills and experience to make sure that people know what they're doing and are able to come together and provide a good balance of knowledge. In terms of appointing people to the board, there has to be a nice, clear, straightforward procedure. So it shouldn't be a case of jobs for friends. So we've got an example. There should be a nominations committee, so a committee that are in charge of nominating people to be appointed to the board, and that should be comprised of at least 50% non-executive directors. So again, that nice independent body, that independent director who can ensure that any nominations to the board are adequate, are fair, are good nominations. Next, then, we say that directors should be able to allocate sufficient time to the company, so we're not taking on too much. And again, for example, the board should not agree to a full-time executive director taking on more than one non-executive directorship in a FTSE 100 company. So if you have a full-time executive director who also wants to be a non-executive director in a different business, they can only have one within a FTSE 100 company. So we've thought about how they're nominated, we've ensured that they have enough time. Let's think about how long they stay for. So down the bottom there, we've got should be submitted for re-election at regular intervals, and specifically all directors of FTSE 350 companies should be subject to annual election, or annual re-election should I say, by shareholders. This just makes sure that directors are held accountable, so they aren't able to just stay on the board forever, regardless of their performance. They're subject to annual re-election, so if they're not doing a good job, they won't get re-elected. This interval is slightly different for other companies, so those companies outside of the FTSE 350. So for those other smaller companies, it's every 3 years. Okay. Next, the next main section then is accountability, so 2.3 here. So we make sure that the board is accountable. It kind of connects slightly with the effectiveness section above. So the board should present a balanced and understandable assessment of the company's position. So making sure that when we're producing our financial statements, that there's a director's report. So there has to be a business review within the director's report that gives an assessment of how the company's done. And this should be from the board's point of view. Should also make sure that there's a sound risk management and internal control system. And the key area here is to establish an audit committee. Now, the audit committee should be made up of at least 3 non-executive directors. At least one of them should have had relevant financial experience. And that's key. We need to make sure that these individuals who are involved in the controls of the business, making sure that controls are monitored, they have to have, or at least one of them has to have some financial experience. Okay, so let's think about remuneration for the board. Obviously, we don't want remuneration to be set by the directors themselves. it doesn't really make sense for people to select their own salaries. So we say there should be a remuneration committee of at least 3, and that's for FTSE 350 companies, or at least 2 for non-FTSE 350 independent directors. In addition to that, we should make sure that the remuneration is sufficient to attract the right level of quality. So paying very little will get very poor candidates. So we need to make sure that we're paying enough to attract the right quality and skill and experience of people to run the business, but obviously shouldn't be paid more than is necessary. So lots of times people assume that when we're talking about remuneration, we're trying to keep it as low as possible. That's not the case. We need to make sure we're paying enough to get the right quality of director. Finally then, and it's a pretty small section in the notes, the study manual, also a relatively short section, is on relations with shareholders. And this is a crucial part of corporate governance. If you consider that, again, let's think back to that agency agreement, whereby our directors are appointed by shareholders to act as their agent. Relations with shareholders is vital. Now we need to make sure, as I said, I believe in chapter 11, we need to make sure we're using that annual general meeting, so the meeting where we get our shareholders and our board together, we're using that correctly. We're using it to communicate with the people who we're supposed to be representing. So those are the 5 main sections of the Corporate Governance Code. Obviously, the actual Corporate Governance Code is much more detailed than that, but this gives us a nice idea of what's included. Your study manual does include a bit more detail in each section, so I would certainly recommend that you have a read through. You'll get a good idea of the level of detail required when you have a look at those questions. So make sure, as always, hopefully as you have been with every chapter, that once you've been through the chapters and watched the online lectures, that you're really attacking those questions, because the questions, as always, are the key here. Okay, and the questions will give you a good indication of what you need to know. Okay, brilliant. Right. Let's have a think about something similar, but from a different angle. So the UK Corporate Governance Code is all about how we direct and control a business. Now, bearing in mind the importance of institutional investors in the UK and in lots of economies, and also considering the importance of the relationship between shareholders and potentially those people who are investing their money on their behalf, the Stewardship Code is a set of principles from the FRC, from the Financial Reporting Council, and it's all about trying to encourage institutional investors who effectively manage other people's money to really engage in corporate governance and consider the interests of their investors, of the shareholders themselves. So it's really important, and again, it's a comply or explain basis. So either they comply or they explain why they have not complied. So we've got three outcomes that we should have. So institutional shareholders, or the institutions that are investing the money on people's behalf, should describe how the principles have been applied, and then either disclose the specific information required under 1, 5, 6 and 7 principles, or explain if these elements have not been complied with. So again, you explain, you provide information, or you explain why that's not been complied with. And we have those principles of the Stewardship Code underneath here. So there are 7. Okay, so firstly, institutional investors should publicly disclose their policy on how they will discharge their stewardship responsibilities. So they have to make sure that all of their individual investors are informed. Okay, informed in regards to what they're going to do in terms of stewardship. So how are they going to look after your money? Number 2, institutional investors should have a robust policy on managing conflicts of interest in relation to stewardship, and this policy should also be publicly disclosed. So what happens when you have a conflict of interest, where you have 2 parties that potentially clash, 2 parties that want different outcomes? How do you decide which of those outcomes you're going to achieve? And again, that should be made available to the individual investors. Institutional investors should monitor their investee companies. And this one sounds sounds almost obvious. Absolutely. If I were to invest my money in a pension fund, I would expect the person investing my money on my behalf, buying shares in businesses, to monitor how well that investment is doing. So absolutely, there has to be some sort of performance measurement. Institutional investors should establish clear guidelines on when and how they will escalate their activities as a method of protecting and enhancing shareholder value. Again, telling me what the parameters are. What action do we take when an investment hits this level? Okay, so really detailing what you're going to do with my money. Number 5, institutional investors should be willing to act collectively with other investors where appropriate. So not just considering their own members, but where appropriate, where it will benefit their own members, or their own investors, joining with other investor groups. Number 6, institutional investors should have a clear policy on voting and disclosure of voting activity. So nice and clear, nice and honest, nice and straightforward. Institutional investors, number 7, should report periodically on their stewardship and voting activities. Okay, so really clear and nothing hidden. Oops, cleary. So nice and clear and transparent. Okay. Right, last couple of bits then for the chapter. We're going to have a quick look at the role of external audit, and we're going to have a look at the role of internal audit. Again, we're trying to consider this in the context of corporate governance still. So, the role of external audit. If we consider, let me just refresh ourselves, or remind you guys of the diagram I would have drawn in chapter 11. And we said that the shareholders own the business, the directors run the business, and they appoint the directors to run the business on their behalf, shareholders that is. Obviously, come the end of the period, the company will produce a set of financial statements for which the directors are responsible. Okay, so the directors are responsible for the financial statements. Now, lots of things will depend on those financial statements. For example, whether or not the shareholders are going to invest more money. So let's stick to that nice, clear decision. The problem we have is we know that these directors have their own, objectives. They have their own things that they want to achieve, and they don't always align with maximizing shareholder wealth. So what happens? The shareholders will appoint external audit to have a look at these financial statements. And what external audit will do is they will give an opinion. They will give an opinion on whether or not these financial statements show what we'd call a true and fair view. Okay, so if you guys, any of you guys work in audit already, you'll obviously be very, very familiar with this. So they give an opinion on whether or not the financial statements give a true and fair view of both the financial performance, so thinking about those P&L or income statement figures, and also its financial position, so thinking about the balance sheet or statement of financial position. Now, we don't need to know too much about what that actually means, but generally it means they're materially free from fraud and error. Remember, material doesn't mean that they check 100%, so it doesn't mean that they're 100% correct, because materiality is really just defined as affecting the economic decisions of users. So if a figure is big enough to affect an economic decision of the shareholder using the report, then we would say that was material. Over the page, what else does it mean? It means that the financial statements will include a fairly stated remuneration for directors, and it will have a statement on the UK Corporate Governance Code and adherence to the UK Corporate Governance Code. Really important that we acknowledge that the external auditor is not responsible for detecting fraud and error. Their responsibility is to provide an opinion. The responsibility for preventing fraud and error lies with those charged with governance. Okay, so we'd call directors and senior management collectively those charged with governance. Okay, so we try and get around the agency problem by having external audit come in and have a look over those financial statements for us. Finally then, for chapter 12, we'll have a look at section 5, the role of internal audit. So we spoke with the UK Corporate Governance Code of the importance of maintaining a good internal control system, and internal audit can be a key part of that. So we call internal audit a semi-independent part, and that's because although we try our best to separate them, they're still employees of the business. So they have a limit in terms of the actual independence that they can have. However, they're really important. So they will perform a lot of the same role that external audit will do. But obviously they're there all the time. So what can they do? They will certainly advise management on improving internal controls. So for example, let's keep it nice and easy. Maybe there's some poor segregation of duties in the finance department. And internal audit will come along and say, look, you can't have this person creating a new supplier and then the same person being able to enter an invoice and pay that new supplier without any sort of approval and so on. We ensure that assets are being safeguarded, so the things that the business owns, we're making sure they're being looked after. Ensuring that operations are conducted effectively, efficiently, and economically, and we call that the 3 E's. And the 3 E's essentially are a measure of value for money. So we're making sure that we're achieving value for money. Ensuring that laws and regulations are complied with, so you'll often have a compliance audit that internal audit will carry out, and they will go through the business's requirements and they'll check which regulations are applicable, and they'll ensure that they're within those regulations. Ensure that records and reports are reliable and accurate. Help management detect or deter fraud. So just having an internal audit department will deter fraud, and helping management to identify savings and opportunities. Again, that links heavily back to my value for money audits. Okay, so that's the Corporate Governance Code in a bit more detail. It's also good to have a look at the Stewardship Code there, particularly after highlighting the importance of these institutional investors earlier on in the course. That's all for Chapter 12. Chapter 13 then, a nice big one on the economic environment of business and finance. Make sure you dedicate or give yourself enough time to work through Chapter 13. And as always, make sure you've had a good look at some questions on Chapter 12. Okay, thank you.